All right, welcome back to Talk Tickers. It is Tuesday, January 27th, 2026. The market is open, the tape is moving, and we're looking at a situation this morning that, it honestly feels a little bit broken.
It's definitely one of those head-scratcher mornings.
Yeah, exactly. We're turning our attention to a regional bank story, Home Bancorp, ticker HBCP.
And this one is a classic conflict playing out right in front of us. You see the press release and then you see the stock price, and they're telling two completely different stories.
They really are. I mean, on paper, this bank just turned in a report card that, frankly, most of their peers would kill for. Record earnings, beating on the top line, beating on the bottom line.
And yet,
if you're watching the chart right now, the street is taking this stock out to the woodshed. It's getting punished.
So our mission today is pretty clear. We have to figure out why the street is selling the news. Is this a huge overreaction, maybe a buying opportunity? Or is there something ugly hiding in the details that the headline numbers are trying to paper over?
That's the million-dollar question. So let's unpack this. We're looking at the Q4 2025 results. Let's start with those headline numbers because they really are impressive.
Yeah, let's do it.
Okay, so GAAP earnings per share came in at $1.46. Now, for context, the Wall Street consensus was looking for $1.39.
Right, so that's a 7-cent beat, a 5% upside surprise. In the banking world, where things usually move by a penny or two, that's a solid win.
And it wasn't just like some accounting trick on the bottom line, was it? Sometimes you see these earnings beats because the company just slashed costs.
No, the top line held up too. Revenue came in at $38.05 million. That beat expectations by about $650,000. So more cash came in the door and more of it stuck around as profit.
And if you zoom out for the full year, because one quarter can always be a little noisy.
The full year number is really the kicker. FY 2025 earnings per share hit $5.87. That is an all-time record for this bank, up 29% year over year.
29%. I mean, you expect those kinds of numbers from a hot tech stock, not a regional bank out of Louisiana. If you're just grading the spreadsheet, this is an A+.
Absolutely. But the market is always looking forward, right? And it is clearly fixated on something else. As soon as the numbers hit the wire, the stock just fell off a cliff.
We're seeing it trade down over 5% this morning, bouncing around that $57 to $60 range.
And it's on heavy volume, which is the important part.
Right. It's not just a few people selling.
No. This is a pretty sleepy stock normally. Trades maybe 25,000 shares a day. Today, we saw over 33,000 shares move right at the open. When you see volume spike like that on a down move, especially after an earnings beat, it tells you the big money, the institutions, they saw something they really, really didn't like.
They're looking past the beat and worrying about the quality of future earnings. Okay, so let's put on our detective hats. Where's the crack in the foundation?
In the regional banking world right now, here in early 2026, there is one thing that spooks investors more than anything.
Credit quality.
Credit quality, specifically non-performing assets, NPAs.
Okay, let's pause right there. Define NPA for someone who might not be a bank analyst.
Sure. An NPA is just a loan where the borrower has stopped paying their bills. It's the bad asset. It's on your books, but it's not making you any money, and you're worried you might not get your original investment back. Investors watch this number like a hawk.
And I take it this number picked up.
It did more than tick up. Home Bancorp's bad assets jumped by $5.2 million this quarter. That brings the total to $36.1 million. Now, that's only about 1% of their total assets, which historically isn't a 5-alarm fire.
Oh, that's the change, right? The velocity.
It's all about the velocity. A $5 million jump for a bank this size gets noticed fast.
So did they say what it was? Is it a bunch of small businesses going under, or is this one big problem?
And that's the key. Management was very specific. The bulk of that increase, about $4.1 million of it, is from a single relationship. It's a deal tied to 2 townhome developments down in Houston.
Houston townhomes. Okay, so development loans, always a bit risky.
It is. But here's where it gets interesting and where you have to decide who to believe. The CEO, John Bordelon, he tackled this head on during the call. He pointed out that the developer never actually started building the houses.
So it's just land. It's just dirt.
Exactly. It's a land deal. They have the land as collateral, and they have a strong guarantor on the loan. So management's argument is, look, we don't expect any material losses here. We're not stuck with half-built houses rotting in the rain. We've got the land, and land in Houston is valuable.
Okay, but no material loss is expected. is pretty standard CEO talk.
Hmm.
Do they give any sort of timeline for resolving this?
They did, and this was the biggest surprise on the whole call. They gave a hard date,
A hard date, really?
February 3rd.
Wait, February 3rd. I'm looking at my calendar. That's literally next week.
Yep, next Tuesday. They expect the property to be sold or the whole issue to be out of foreclosure by then. That is an incredibly specific promise to make.
That is unbelievably bold. Usually you hear in the coming months or by the end of the quarter to say next Tuesday puts a huge target on their back.
It does. But clearly, the market is not waiting for next Tuesday. The stock sold off as if that $4 million is just gone. Poof. It just shows you how trigger-happy investors are with regional banks right now. They see one bad number, and they sell first and ask questions later.
A fascinating dynamic. You have management saying, relax, it's a secured land deal, it'll be gone in a week, and the market screaming, we see smoke, the whole building must be on fire.
Exactly. But that wasn't the only point of friction in the report. We also need to talk about their profitability, the engine of the bank.
Right. Net interest margin, the NUM. But basically the spread between what they make on loans and what they pay out for deposits.
Correct. The NIM came in at 4.06%. Now, that's down 4 basis points from last quarter. It's not a disaster, but it is compression. They're making a little less money on every dollar.
And why is that? I thought with the Fed pausing, margins were supposed to stabilize?
It's a mechanical lag effect from the Fed cuts we saw last September. When the Fed cuts, a bank's floating rate loans reprice downward almost instantly. So their income takes an immediate hit.
Okay, so their loan yields fell 9 basis points. But shouldn't their deposit costs also fall?
Eventually, yes. But there's a lag. It's like an elevator versus the stairs. The loan yields take the elevator down, it's fast. But deposit costs, especially CDs, they have to take the stairs. If you locked in a 1-year CD at 4%, the bank has to pay you that 4% until it matures.
Right, they're stuck. They can't just change the terms on you.
Exactly. The CFO, David Kirkley, she explained it. You get this temporary window where income drops before your expenses can catch up. And that pinches the margin.
So it's a timing issue, not a fundamental breakdown of the business.
Precisely. And looking ahead, they're still asset sensitive. They're actually guiding for the NIM to tick back up to a range of 4.10% to 4.15% through 2026 as those pricey CDs roll off.
So if you believe the credit thing is a one-off that's fixed next week and the margin thing is just a temporary lag, the actual business looks pretty healthy.
It does. But you can't just own a bank because it's not broken. You need a growth story. And for Home Bancorp, that story is not happening in Louisiana anymore. It's in Texas.
Texas.
Yeah.
The growth engine for everybody these days.
It really is. They're a Louisiana bank by heritage, but the action is all happening next door. They're heading into their 4th year in the Texas market, mainly Houston.
And the growth there has been pretty explosive, right?
It's been huge. They've got 15 commercial bankers there now, 5 branches. And since 2022, their loans in Texas have grown at a 15% annual clip.
15% annually. That's incredible for a bank.
It's massive. Texas is now 20% of their entire loan book, and they're doubling down. They just announced they're opening a new full-service branch in Northwest Houston this quarter.
And that's important because they're replacing what's called a loan production office, an LPO. Why does that matter?
It matters because an LPO is just an office for loan officers. You can't make a deposit there. By upgrading to a full-service branch, they're signaling they don't just want to lend money in Texas, they want to gather cheap deposits there too.
Which feeds that whole profitability engine we were just talking about.
Exactly. And this confidence is reflected in the biggest change of tone on the whole call. If you remember, their guidance for 2025 was for like 1 to 2% loan growth.
Yeah, that's basically just standing still.
It was very defensive, cautious. But for 2026, they've completely flipped the script. Management is now guiding for mid-single-digit loan growth.
Wow. That's a huge pivot, going from maybe 1% to, say, 5 or 6%. That's a different company. What changed?
Well, for one, loan paydowns are slowing, and their pipeline is building. They had a really strong December. Management is basically signaling they're shifting from playing defense to playing offense.
That's a bold move right after the market slapped them for a credit hiccup.
It is, but it shows they feel they have the capital, the dry powder, to do it.
So let's talk about that dry powder, capital allocation. Usually when a bank stock sells off like this, you hear management screaming about share buybacks. Our stock is cheap, we're buying it back. Did we hear any of that?
Interestingly, no. They've actually throttled way down on the buybacks.
Why? Wouldn't this be the perfect time?
Well, their logic is that the stock, even after this drop, isn't actually cheap enough by their main metric. It's still trading around 140% of tangible book value.
Okay, so tangible book value. Break that down for us real quick.
Think of it as the liquidation value. If they shut down the bank tomorrow, sold everything, paid all the bills, what would be left for shareholders? So at 140%, the market values them at a 40% premium to that.
And management thinks that's a fair price, so they'd rather use their money elsewhere.
Exactly. And elsewhere in banking usually means M&A, mergers and acquisitions. They were very direct about it. They said they have active interest in looking for a deal.
So they want to be the buyer, not the seller.
Yes, they're looking for banks half their size or smaller. And because their stock has held up pretty well, trading at that premium to book, they have a strong currency to go shopping with.
Meaning they can use their own stock to buy another bank instead of just cash.
Exactly. So they're thinking about expanding the franchise, not just shrinking the share count. But to do any of this, you need a solid funding base. You need deposits.
Right, and how does that look?
The deposit story is really the unsung hero of this quarter. Deposits grew 7% last year, but the real headline is the cost. Their cost of interest-bearing deposits is 1.84%.
Hang on, pause there. 1.84%. When I can go online and get a money market account paying 4.5%,
It's the power of being a true community bank in places like rural Louisiana. They have customers who've been there for decades, small businesses. It's a sticky, low-cost base that their competitors would kill for.
that's a massive competitive advantage.
It's huge, and it means their loan-to-deposit ratio is down to 92%. They have plenty of cash on hand to lend. They aren't constrained at all.
Okay, so let's put all the pieces on the board. Record earnings, a cheap and stable funding source, a growth engine in Texas, and a management team ready to play offense on M&A. But a big, ugly black eye from one bad loan in Houston that scared the market into a 5% sell-off.
That is the entire picture. Great fundamentals, terrible headline.
All right, this brings us to my favorite part of the deep dive. I want you to put on your hedge fund analyst hat. Forget being prudent. The market hates this stock today. Pitch me the aggressive, slightly crazy trade. This is not financial advice segment.
Okay, I've been thinking about this one. Let's call this trade the Texas Hold'em arbitrage.
I love it. Lay it out.
The setup is simple. The market sold off HBCP almost entirely because of the fear around that $4.1 million townhome NPA. The market is pricing it like it's a total loss and maybe the first of many.
The old one cockroach theory.
Exactly. But management gave us the tell. They gave us that hard date, February 3rd, next Tuesday.
So the whole trade hinges on that date.
It's the trigger. The trade is this. You go long HBCP right now at these depressed levels around $58.50. You're making a very specific bet that this sell-off is a massive overreaction to a secured land deal that gets resolved in 1 week.
You're betting their dirty laundry is just a minor spill that washes right out.
Right. But here's the kicker. You pair the trade. You go find another regional bank, maybe one with heavy exposure to empty office buildings, not secured land, and you short them.
So you're long the townhome scare and short the office apocalypse.
Precisely. You're betting that Home Bancorp's credit problem is technical and temporary. If they announce on February 3rd that the NTA is cleared, the stock should snap back to $62, maybe higher, instantly. The credit fear just evaporates. You capture that quick pop, and you get to ride the new higher growth guidance for free.
And the short position on the other bank protects you if the whole sector rolls over.
It protects you from macro fears, yeah. But it's really a bet on collateral quality. Land in Houston versus an empty office tower somewhere else. It's a bet on management's credibility about one specific date.
That is a high-stakes bet. If they miss that February 3rd date,
Oh, the trade gets painful. If that NPA is still sitting there on February 4th, the stock probably drops again because then management has a credibility problem.
high-stakes poker. I guess that's why you call it the Texas Hold'em arbitrage.
Exactly. And remember, deadlines in real estate and law can be slippery. So it's a trade, not a long-term investment.
Absolutely. And for everyone listening, that was purely a hypothetical for entertainment. Please do your own homework.
Always read the footnotes yourself.
So to wrap it all up, Home Bancorp post record earnings, they raised their growth guidance, they have an M&A war chest, but they got tripped up by a single scary headline.
It just shows you where the market is right now. Good execution, that's just expected. Beating earnings is the price of admission. But credit safety, That's what is being demanded. The market has zero tolerance for any credit surprises.
And Home Bancorp has to prove that this Houston deal was just a one-off.
If they do that, then yeah, this dip looks like a gift. If more cracks start to show, then the market was right to run for the exits.
We will definitely be watching that February 3rd tape. That wraps it up for us on Home Bancorp. This has been Talk Tickers. Keep your eyes on the tape.
See you next time.